There's something that powers our entire global economy every single day, but most of us never even see it. We're talking about the money markets, the essential, hidden plumbing of finance. Okay, let's dive right in.
So let me just start with a question for you. Imagine you're a huge company like Apple, or even the US government. You've got billions, literally billions of dollars in cash that you need to keep safe, but you also need it to be accessible, maybe just for a week, or even just overnight. Where do you put it? I'll tell you one thing, your local savings account isn't going to cut it.
And the answer is the money market. I want you to think of it like the financial system's central nervous system. It's this vast, unseen network where all the short-term cash needs are met, making sure money is constantly flowing where it needs to go, literally keeping the whole economy running smoothly.
So how does this market actually work? Well, it uses special tools called money market instruments. At their core, they're just short-term loans, always, and I mean always, maturing in less than a year. Their entire purpose is really simple: provide a super secure place to park cash or a super quick way to borrow it.
Now, what's really fascinating is how these four features all feed into each other. Because the maturity is so short, and the folks issuing them are incredibly reliable, we're talking governments and top-tier corporations, the risk is extremely low. And that, in turn, means they're highly liquid and their prices don't really bounce around. It's all about safety and access, not about chasing huge returns.
So let's pull back the curtain and meet the key players. We're going to take a quick tour of the most important tools of the trade that make up this absolutely massive market. First up, we've got Treasury bills, or T-bills for short. These are the absolute gold standard when it comes to safety. And why is that? Well, it's because they're backed by the full faith and credit of a national government. They are, for all intents and purposes, considered risk-free.
So here's how they work. Governments issue T-bills to fund their day-to-day business. Now, as an investor, you don't get a regular interest check. Instead, you buy the T-bill at a discount. So, for example, you might buy a $10,000 bill for, say, $9,950. When it matures, you get the full 10 grand back. And here's a really nice perk. In the US, the money you make is exempt from state and local taxes.
Okay, next, let's pivot from the government to the corporate world and talk about commercial paper. The easiest way to think about this is as a short-term IOU from a very big, very financially stable company.
Okay, the crucial thing to understand here is that commercial paper is unsecured. That means there's no collateral backing it up. And that's exactly why only companies with the best credit ratings can get away with it. They use the cash for everyday expenses like making payroll or managing inventory. And that maturity, less than 270 days, that's not random. It's kind of the magic number that lets them issue this debt without going through the whole lengthy SEC registration process.
All right, next up are certificates of deposit, or CDs. Now, you might have heard of these from your own bank, but in the money market, we're talking about massive, jumbo CDs. They're a really key tool for big institutional investors.
The deal with a CD is pretty simple. You agree to lock your money up with a bank for a set amount of time, and in return, you get a guaranteed interest rate. That makes for incredibly predictable returns. They're also FDIC insured up to $250,000, which adds another layer of safety. But, and this is a big but, be warned, there are some hefty penalties if you try to pull your money out early.
Okay, now we're getting into the real nuts and bolts of how the financial system operates day to day. Let's talk about the repurchase agreement, or as everyone calls it, a repo. So how in the world does a repo work? Well, it's essentially a loan, often just overnight. One bank sells securities, like those T-bills we talked about, to another and promises to buy them back, maybe the very next day, at a slightly higher price. That little price difference, that's the interest. But here is the big takeaway. This isn't just a tool for banks. Central banks, like the Federal Reserve, use the repo market every single day to pump money into or drain money out of the system. It's one of their most powerful tools for steering the entire economy.
So now that we've met the players, it's really important to see where the money market fits into the bigger financial universe. So let's compare it directly to its more famous and maybe flashier sibling, the capital market.
The difference really boils down to this. Money markets are for the short game. It's all about managing your cash, prioritizing safety and liquidity, and you get pretty modest returns. On the flip side, you have the capital markets. Think stocks, long-term bonds. That's the long game. That's for funding growth, building new factories, which of course means taking on higher risk for the potential of much higher returns. They serve two totally different but equally vital purposes.
Okay, so let's bring this all into the here and now. How is the economy of 2025 actually shaping these markets? Well, as it turns out, the big economic picture has a direct and really powerful effect on the kinds of returns you can get.
And here's a really key idea to get your head around. It's not just about what interest rates are today. It's about what investors think they're going to be tomorrow. This market is always trying to look around the corner. Even just a hint from a central bank about a future rate cut or a hike can send yields shifting almost instantly.
And you can see this playing out right now in today's restrictive monetary environment. It makes a huge difference. Money market instruments are offering some really attractive yields. I mean, a top CD or a short-term T-bill is yielding well over 4%. And look at that, it just blows the average savings account right out of the water.
Looking at the snapshot for August 2025, you can see yields are strong pretty much across the board. You take that, you combine it with some economic uncertainty and an inverted yield curve, which is just a fancy way of saying short-term rates are higher than long-term rates, and you get what's called a flight to quality. Investors are basically rushing to pour their money into these safe, high-yielding instruments. But, this system isn't perfect. It's not without its vulnerabilities. After we saw some major stress back during the pandemic in 2020, regulators have stepped in with a whole new set of rules designed to, fortify the financial plumbing.
Yeah, after that really stressful period, the SEC rolled out some major reforms. They're aimed squarely at money market funds, which are basically mutual funds that invest in all the instruments we've been talking about. These funds are massive players, and the new rules, adopted in 2023 and being phased in through 2024, are all about making them safer.
So, what are these changes exactly? Well, there are 4 big ones. First, they're getting rid of so-called redemption gates, which means funds can't just slam the door shut on investors who want their money back. Second, they're introducing mandatory fees during stressful times to make big investors think twice before starting a panic. Third, funds now have to hold much larger cash buffers. And finally, reporting is getting way more detailed, so everyone has a clear view of what's really going on under the hood.
So if there's one thing to take away from all this, it's that the money market isn't some obscure, boring corner of finance. No way. It's the engine room. It is the low-risk, high-liquidity bedrock that allows governments to function, companies to make payroll, and central banks to steer the economy. It's absolutely vital.
Which, of course, brings us to our final question. All these new rules are designed to make the system stronger, more resilient than ever before. But in the world of finance, can anything ever be truly crisis-proof? That's a good question to think about. Thanks for joining this Explain.